Today we're going to be talking about the government I-bonds that as of right now are yielding interest of 9.62%. A lot of emails and calls from clients basically asking, is this too good to be true? Am I missing something here? No, these bonds do exist. They're government issued bonds with this guaranteed interest rate, but it's important to know that that interest rate is only fixed at that rate for 6 months, and then it goes through a recalculation process. But there are also redemption restrictions that you have to be aware of before buying these bonds. In this video today, I'm going to walk you through how do these I-bonds work? Are they a safe investment? What are the purchase limitations each year? Why does that interest rate vary over the life of the bond? How do you actually go about purchasing one of these I-bonds? What are those redemption restrictions that I just mentioned? And what are the tax considerations? Thank you everyone for joining me for this video. I'm Michael Ruger, the managing partner of Greenbush Financial Group. Let's jump right into how these I-bonds work. So these are government savings bonds that are issued by the US Treasury. They issue interest and they compound interest every 6 months, but the interest does not go out to the bondholder. The interest continues to accumulate within that bond, adding to its value until the bondholder either redeems the bond or it matures, but it has a 30-year maturity cycle. These bonds have what's called a variable interest rate, means it actually moves around every 6 months. So unlike a bank CD that you have a fixed rate over the life of that CD until it matures, the interest rate on these I-bonds are gonna move around, and there's two components to the interest rate. There's a fixed interest rate component and there's an inflation rate component. The fixed rate component, as the name suggests, is a fixed minimum interest rate that the bond pays over the entire life of the bond. But the bonds that are being issued right now, the fixed interest rate is 0%. Most of the return right now in that interest rate is coming from the inflation rate side, which is variable. It moves around. The Treasury actually resets that inflation rate in May and every November. So that May rate was at 9.62%. You can purchase bonds all the way up to October until they recalculate the rate in November. The benchmark that they use for determining the inflation rate is the CPIU, which stands for Consumer Price Index for all urban consumers, excluding food and energy. If you're watching this video sometime after November 1st, 2022, I will put a link to the website that shows all the updated rates. When they go to recalculate your rate every 6 months, it is based on the month. That's when your 6 months start that you actually purchased a bond. So everyone could kind of be on a different rate recalculation cycle. And I'll show you the chart that came directly from the Treasury Direct. So you can see, let's say, the issue month of your bond was March. So if you look at when do the new rates take effect in that right-hand column, so your rate reset would be on September 1st and March 1st. Vice versa, if you purchased it, let's say May, your 6-month resets are gonna be May 1st and November 1st. Let's look at this in an example. So you purchase your I-bond in September 2022 at a rate of 9.62%. That means over the next 6 months, that bond will pay you 4.81%, which is half of that annual 9.62% annualized interest rate that they're showing you. Then they're gonna recalculate everything on March 1st, 2023, which is your first 6-month reset, and then you're gonna receive the new rate based on whatever that new inflation rate is. Then from March 2023 to August 2023, your next 6-month period, you receive that rate, and then the rate recalculates again as of September 1st, 2023, and that cycle continues until you either redeem the bond or it matures. When people hear that the fixed rate right now is 0, I will sometimes get the question, when was the last time the fixed rate was something other than 0? And you actually have to go back to May 2019. In May 2019, the fixed rate was 0.5%. And the last time that fixed rate was above 1% was actually November 2007. So it's been a while. That will lead to the next question, which is if the fixed rate is 0, and if we get deflation, is there a chance I could ever lose money in these bonds. And to please my compliance department, I'm going to read this directly from what's on the Treasury website. The answer is no. The interest can't go below zero, and the redemption value of your I bond can't decline. That's directly from the website. This is the part where people start asking, what's the catch? There's got to be something that's too good to be true. I can't lose money. I'm getting a 9.6% annualized rate of return. What gives? Can I just purchase $100,000 of these bonds? And unfortunately, the answer is no. They do put restrictions as to how much you can purchase each year. And for most taxpayers, it's going to be $10,000 per person per year. Now, some taxpayers may be able to purchase $15,000 in a year because what they allow you to do is purchase $10,000 outright. But if you get a federal tax refund, instead of getting that refund back, they'll actually let you buy up to $5,000 in additional I bonds with your Fed tax refund. But this $10,000 limitation goes beyond just you. If you're married, then you can purchase a $10,000 bond for you and your spouse. They allow you to purchase a bond for anything that's got pretty much an EIN number. So if you own, let's say, an S Corp and it's got a tax ID number, then the S Corp can technically buy a $10,000 bond too. When it comes to trusts, some people have trusts that have their own tax ID number. You could buy one and your trust could buy one. You can buy one of these bonds as a gift to someone else. One of the most common ones is parents buying a $10,000 bond and the social security number of their child, or a grandparent for a grandchild. Let's put this all together in an extreme example. So let's say we have a family with 2 parents, 3 children. One of the parents owns an S Corp business, and each of the parents have a trust with an EIN number. So that's $10,000 for one spouse, $10,000 for the second spouse, $10,000 for each of the 3 kids, $10,000 for the S Corp, $10,000 for each of these trusts. You total that all up, and they can purchase $80,000 worth of I bonds in one calendar year. And that's every single calendar year. So as long as that structure stays the same, they could put $80,000 worth of cash to work every single year. There are some small restrictions when you go to try and sell your I bond. So they require you to hold it for at least 12 months. You cannot sell them within a 1-year period. Once you're past that 1-year period, between 1 and 5 years, if you redeem the bond within 1 and 5 years, you actually forfeit the recent 3 months worth of interest for that bond. So not a huge penalty, but it's there. And then once you're past 5 years, you're free and clear. You can redeem it as you please without penalty. How is the interest on these I bonds taxed? So you do have to pay federal income tax on the interest, but you don't have to pay state and local tax on the interest, but you have a choice how to realize it. So you can choose to let the interest accumulate and you don't pay any tax on it until you either redeem the bond or it matures. But the second option is you can elect each year to realize the interest that is accumulated over the life of the bond. A word of caution about realizing the interest each year. It's an all or nothing thing, which means as soon as you start realizing interest as you go, you have to do that for all of your I bonds and also all of the I bonds that you're going to purchase in the future. You kind of lock yourself in. The way you purchase these I bonds is actually really easy. You just go to the Treasury Direct website, you establish an online account, and then you can purchase them directly from there. Any new bonds that are issued are all in electronic format. The only way you can get paper bonds now is if you're buying them with those federal tax refunds. So if you're buying it with that up to $5,000 in your federal tax refund, they give you the option of whether you want it electronically or in a paper bond form. The minimum purchase amount for these bonds is very low. For the electronic bonds, it's only $25, and they don't even issue them in increments above that. You can do it in cents. So if you wanted to buy I bonds for $85.31, you could go online and do that. Versus the paper bonds, they actually have stepping increments. How do you actually redeem your bonds? So if they're in electronic format, super easy. You just log into your account online and you go to that section of the website and you can sell your bonds immediately. If you have physical paper bonds, there's 2 options. So some banks, if you go to your bank and ask them, do you redeem I bonds? Some banks still do, but if they don't, then you're actually going to have to mail those bonds in. You mail them in to the Treasury Retail Securities Service with form FP Form 1522. The mailing address is actually listed on that form. You do not have to sign the back of the bond when you mail it in, and there's some identification information that you have to send in with the form. If you've had some of these bonds for a while and you're not sure what they're worth, like how much interest is accumulated, the electronic bonds are easy. You can just go online, log into your account, you can see the value. If you have paper bonds, there's actually a calculator that Treasury Direct provides to you, and I'll put a link to that in the description below. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.